Good afternoon, everyone. I'm Birgit Close, the President and CEO of The Right Place, and I want to welcome you to our first webinar in a new series that The Right Place is presenting called Navigate 2020. We're all getting used to doing business very differently today, and this webinar series is one of our efforts to keep you up to date on very important topics during this crisis and after the crisis. We're facing unprecedented challenges today as we grapple with COVID-19 in our community. And The Right Place was founded 35 years ago during a not too dissimilar crisis when our unemployment rate was very high as well. And we've been working with you, our business community, for all those years to help you through these tough times, which is why we also launched this new webinar series. It's designed to bring you expertise and resources that we hope will help you as you get through this crisis, come out of it, and restart your businesses. We will be bringing you topics of interest to you every month, and we will be starting off today with a forecast from Rick Mattoon of the Federal Reserve Board of Chicago, and we thank Rick for coming. Before I hand it over to Rick, I have a few housekeeping items that I want to share with you. We will be recording the webinar today, and we will share it with all of you after the session. All participants will be muted and video is off, but if you have questions, please type them into the Q&A box at the bottom of your screen. And at the end, Tim Moraz, our Senior Vice President of Strategic Initiatives, will facilitate the Q&A sessions with Rick Mattoon. Now I would like to hand it over to our speaker, Rick, and Mr. Mattoon is the Senior Economist and Economic Advisor in the Research Department of the Federal Reserve Board of Chicago. His research focuses primarily on issues concerning the Midwest regional economy, and I want to thank him sincerely for joining us today. Rick, with that, I'll turn it over to you.
Great, thanks very much, and I really appreciate the opportunity to be here and to talk to your audience today. Clearly, we're going through somewhat unprecedented times, and clearly part of this is that it's a significant health issue, and one of the things I want to be very sensitive about is while I'm going to be talking about the economic impacts of this, I don't want to in any way possible underestimate the health impacts that people have had both in their families and across communities. So all those things are actually quite important in terms of that. So today I'm going to present you with some sort of indications of where we think the economy is headed in light of the COVID crisis. We also want to be able to make it clear that these are my own views, not those of the Federal Reserve Bank of Chicago or the Federal Reserve System, and that is simply one of the things that we sort of always have to say as a disclaimer going forward. So with that, let's go to the first slide. So the first thing I want to do is look at consider, can we advance the first slide? Is where we thought the economy was going to be going into next year, which is, if I had talked to you in January, what we would have talked about is an economy where economists had a remarkably similar view as to where things were. There was a consensus that U.S. economic growth was going to be a little bit above, trend growth, GDP coming in between 2 and 2.2%. The reason why economists were so sort of sanguine in terms of their outlook was that they saw an economy was being driven by a very robust consumer. We had tight labor markets that was driving up wages. We saw low interest rates, which would encourage borrowing and encourage spending to drive the economy. There was also a sense that trade frictions were starting to lessen going into the end of last year. And this might lead to business expansion, which would also support business investment. So again, a very sanguine outlook. So next slide. If we can look at, so what happened? Well, so COVID obviously is something very, very different from anything we've ever seen before. This is in many ways a black swan event. And one of the things that people I think are trying to wrestle with at this point is understanding how the economy will respond when you really don't have a template for understanding what has occurred relative to other events that have happened in US history. So this isn't really like any other recession. You can't really use the Great Recession as a template for describing describing how we might recover from this, or even the Great Depression, because those were driven by very different factors. The Great Recession was largely a self-imposed financial crisis on the economy. If you try to model it relative to this being a natural disaster, that doesn't really work either, because in the case of most natural disasters, the duration of the event is known. A hurricane is over in a day or two. And so therefore you can know sort of what recovery is going to look like going forward. So the idea here is this is a very, very different crisis, and it makes sort of modeling it a lot more difficult than in the past. So one thing you should consider is that this is being felt very unevenly. You have to be really specific when you think about how this is going to affect local economies. It's going to be based on what the industry mix is, whether that industry mix is particularly exposed to shutdowns that are related to the COVID crisis. For governments, it's going to have a lot to do with what kind of revenues you rely on. And all those suggest that the impacts are going to be sort of variable across different parts of the economy. So the next thing I want to do is show you sort of where things are in terms of the forecast. So the first official US GDP estimate came out a couple of weeks ago, and it showed annual US GDP growth declining at about 5%. That obviously understates actually where the economy is at this point. The first quarter, obviously only the very tail end of that really was exposed to COVID, but it also shows just how sharp the impacts were, because you had such a sharp decline in a GDP number that for the first 2 months, frankly, had been quite strong. So this leads to the next thing I want to share with you, which is sort of where forecasters think the economy is headed. So this is a sort of a group of 9 different private forecasts, and it's the annual percent rate change in US GDP by quarter. As you can see, the forecast numbers are pretty much all over the place. So the first thing you should look at is that the median projection for this group was for a 3.6% decline in GDP in the first quarter. Obviously, it was slightly worse than that. If you follow this particular projection out, you're looking at a 34% decline in the second quarter, and then somewhat of a recovery. Not a full recovery, but kind of a soft U-shaped recovery, with GDP reigniting growth with 19% in the third quarter and 10% in the fourth quarter. If you take the best projection, so the most optimistic projection, it only has US GDP declining 24.5% in the second quarter, but then a very sharp, almost V-shaped recovery coming out, with 35% growth in the third quarter and 16% growth in the fourth quarter. And if you're a pessimist, as you can see, you're seeing a much sharper decline, of 45% decline in the second quarter. But what you're also seeing is a very, very shallow recovery. This is almost an L-shaped recovery, where you're going to see very little growth through all of 2020. So it just shows you sort of the differences in the way people are looking at this. A fundamental question I think that people should consider is this a liquidity event or a solvency event? And let me explain what I mean by that. For some businesses and governments that went into this with large reserves and less economically sensitive revenues, what they're seeing is revenue is being delayed, not necessarily destroyed, over this period of time. So what they're facing is a cash flow problem. When things open back up, they essentially sort of get back to where they were and actually recover some of the lost revenue. For others, however, it's both. It's both a cash flow crisis right now, but it's also that part of the demand that they were experiencing in the past may have been actually destroyed. And so what you're seeing there is businesses that may not be able to see the same level of revenue recover coming out of this, and they may have to make some significant changes to their businesses. Really, the most important thing to think about is how the consumer is going to react when we return to this more new normal or new recovery. And so that's the next thing I want to consider here, is consumer behavior. One of the things that economists really developed over this period of time was a fair amount of hubris when it came to understanding the role of behavioral economics relative to sort of traditional economics. And what we found was, coming out of the Great Recession, is people didn't respond the way that economic models thought they should. So theory suggested that coming out of the Great Recession, as soon as you dropped interest rates to super low levels, you put in a lot of federal stimulus through, at that point, the ARRA program, that consumers would not only spend, but they take on debt, because they would realize that conditions for taking on debt would be really favorable over this period of time. And the same behavior was expected for firms. However, what behavioral economists saw was a shift in basic sort of human behavior. What essentially happened is people became very risk averse. So the appetite for taking on risk was significantly diminished. People and firms chose to deleverage and increase savings rather than take advantage of these super low interest rates to leverage themselves up. So having reserves became more value than pushing the limits on growth through leverage. And that was a change in behavior. And again, economic models, traditional ones, wouldn't have predicted that. So what's going to happen this time around? So again, I think there's a good time for humility, but I think you can also suggest that how you're going to view how the consumer is going to behave is going to depend on sort of three different scenarios. So in the best case scenario, what I'd suggest is you have something along the lines of an effective vaccine is developed or herd immunity becomes available relatively quickly, early fall, late or early winter. In this case, the risk of COVID infections basically dropped to near zero. People have confidence they can go back to a pre-COVID lifestyle, and you get maybe a V-shaped recovery. So again, you have this sort of postponement of activity, but it really fills in very rapidly right away. The next sort of intermediate case scenario is a vaccine is still in development, but hasn't been proven, but there is an effective treatment protocol or some structure in which we're minimizing both the death toll and the impact on the healthcare system. That suggests that some sort of social contact distancing is still going to have to occur. Things will be less risky, but there's going to be limits that are going to sort of, curve the sort of pace of the economy going forward. So some recovery of economic activity, but clearly not to what we had pre-COVID. The least good case is that there's no vaccine or effective treatment protocol that's developed. And the only thing you can do is use social distancing and maybe tracing to be able to sort of limit the exposure people are having to the virus. And I consider this kind of the Spanish flu case. In the case of the Spanish flu, it was the second wave of the infections. It was actually more deadly than the first wave. So what you're looking at that point is simply that we would have actually a worse time in the fall. So let's talk a little bit more specifically about where the impact has been most noticeable. And it's really across these 5 dimensions. So clearly the labor market, unemployment claims came out again. We're reaching sort of unprecedented highs in terms of the people who are falling into the unemployment lines. Financial markets are experiencing a lot of volatility. For a period of time, we saw significant fund outflows, which was quite concerning, suggesting that financial markets really weren't working appropriately. Government is seeing 2 different types of shocks, a revenue decline that's been very profound, but at the same time, spending spikes for things like unemployment insurance and Medicaid expenses. Consumers seem to be behaving by hunkering down and increasing their savings. And I want to talk a bit about who the most exposed industries are. So if you look at labor markets, this is a figure that frankly, we've never seen before in US history. So this is a smoothed average of weekly unemployment claims in the United States. So this is the smooth behavior over the 4-week period. As you can see, the spike is just extraordinary. The line just literally takes off almost in a vertical direction. So that's obviously quite concerning and shows just how heavily the labor market's been hurt by this. If you look at financial volatility, it's the same story. So what I've done here is show what's referred to as the VIX index. This is something that the Chicago Board of Exchange does, which shows volatility in markets. And what it shows is this takes it back to the period coming out of the Great Recession. And as you can see, that was a time of, again, sort of extraordinary volatility, but even then, you didn't see the VIX actually crest above 50%, the 50 number on the index. This time around, you had volatility cresting at above 80, and we're still at elevated levels in the 30s right now, even after this period of time, which just suggests that, again, this is a very unprecedented period of time in terms of the spike in sort of behavior within financial markets. Now, the one surprise has been kind of the stock market recovery. As you can see, the market has really risen quite sharply coming off of the trough of this period of time. There's a lot of explanations that people have offered for this. Some have suggested that, again, there's some confidence that we'll have recovery by the fall. There's also some confidence that given the sort of extraordinary low interest rates, that firms will be able to act fairly aggressively coming out of this. But obviously, given that when you match this with volatility, it suggests that, again, there's some nervousness as to exactly where the direction of financial markets are headed. So one of the things that you should really notice is, again, this is a consumer-driven economy where 2/3 of U.S. economic activity is dependent on the consumer. And you can see that this is where the effects is being shown up the most. Frankly, the consumer just stopped buying. You can see this is advanced retail sales excluding food services, and you can see the line just drops off. And as the next figure will show you, is that it's pretty much across every category of retail that you can think of. The only thing that has grown is non-store retailers. That's essentially anything online. But if you look at everything from even building materials and garden equipment, which originally had done fairly well, is now contracting, to things like clothing and accessory, which have essentially cratered. I mean, you've seen an 80% drop in clothing and accessory sales. Electronics and appliances, similar furniture and homes. These are just extraordinary sort of destruction of demand in retail sales. And the April numbers were simply terrible. It'll be interesting to see in May, with a little bit of recovery, a little bit of opening in some places, whether we see any sort of improvement in these numbers. But again, it's something to pay attention to. So the next area you want to think about is what happens to consumers when they stop buying stuff and they face uncertainty. And what happens is they start saving, and they start saving at extraordinary levels. The March savings rate in the U.S. went above 13%. We haven't seen that in really almost at any time in U.S. history. And it just shows you, again, in the face of sort of uncertainty and fear, people start really hunkering down. So let's talk a little bit about specific industries. So Brookings and a number of other economic think tanks had tried to identify at the initial point of the COVID breakout, which industries were most exposed. And these are a mix of consumer-facing retail or those who are exposed to oil or material or mining. As you can see, what they showed is that these particular 5 industries were they felt the most exposed in terms of job losses and sort of just drop off in demand. And they represent about 16.5% of all employment in the United States. So that's a pretty significant number. If you look at the next picture, is that you have to realize there's also been a sort of an evolution in how this has happened. So in research that we've been doing and in talking to people throughout the Midwest, what we found is that the first impacts were clearly felt by these industries that were consumer-facing businesses. Anything that was essential, non-essential retail essentially almost had an immediate shutdown and very severe effects. However, what we're noticing now is sort of secondary impacts starting to play into the situation, which is it's started to show up in manufacturing. For a lot of manufacturers, what they noticed is customer demand basically was falling away as recovery became more uncertain. And while previously they hadn't been particularly worried about seeing this sort of the downturn affecting them in such a stark way, now all of a sudden they were starting to see some exposure. The one area we also continually hear problems about is supply chain strains. Many of the manufacturers were essential businesses, so they continued to operate, but many of their suppliers weren't. And so what they're seeing is disruption in their ability to get the sort of parts they need to continue production. So that's clearly something that we're seeing and they're somewhat concerned about. And one of the things we also think is going to be important is thinking about supply chains in the future. Post-pandemic, are you going to want to build more resilience into your supply chains? Are you going to be in a situation where one of the things you're going to be looking at doing is maybe bringing more of your supply chain domestically at this point? Or will you continue to sort of try to source it in different ways internationally? It's going to be a key consideration going forward. Okay, so the next thing I want to do is just show you two heat maps. And this just shows you sort of the metropolitan distribution of where the industries that are being most impacted are located. As you can see in these early sort of slides, the darkest red or the maroon shaped colors are really those are tourism and particularly energy affected economies. So you're seeing the South and the West being particularly impacted in terms of where these effects are, but really there's no part of the country where you're not seeing somewhat significant impacts. If you look at the next slide, it's going to show you the effect in terms of unemployment rate changes, again, throughout the US by metropolitan areas. And again, it's concentrated heavily in the South and the West, but as you can see, there's plenty of pockets throughout the Midwest where you're also seeing very significant sort of changes in unemployment rates, real spikes in unemployment levels. If you want to talk specifically about Midwest exposure, this is work, again, that was done by Brookings. And what I did here was focus on particularly just the cities in the Midwest that they ranked in terms of being whether they were immediately exposed or midterm exposure in terms of how COVID would play off. And this is across two dimensions. So the first is how exposed are these local economies, general fund revenues? So how exposed is the government to a COVID-related shock? So do they have revenue sources that are particularly economically elastic? And then the second thing is you pair that with the share of metropolitan employment that's in high-risk industries. So it combines both a fiscal shock and an industry shock. And as you can see, Michigan, unfortunately, is not well positioned this way. Grand Rapids actually is ranked 10th in terms of exposure out of 140 metros. And most of this is because Grand Rapids has a general fund revenue structure that's more dependent on income taxes and sales taxes than many other cities. Many other cities are mostly exposed, as you'll see, like with Chicago, to property taxes, which are going to be pretty stable over the midterm in terms of the behavior in this. So it's expected to have a bigger sort of revenue shock on places like Grand Rapids, Detroit, Dearborn, and Warren. And you can see the exposure actually on the industry basis is, while it's sort of mid-range, it's not extraordinarily high. So really it's being driven mostly by a fiscal shock to the local government structure that's going to make the exposure, particularly in a place like Grand Rapids, higher. So what has government done in response to this? Well, I think one thing that people notice is the answer is a lot, and the other is it was done fairly quickly. So you had the CARES Act passed. That was over $2 trillion in federal funding. Michigan got $3.9 billion out of that. 800 million of that went to local governments, over 500,000 in population. 900 million went to high impact hospitals. So it was a desire to try to offset some of the COVID effects fairly immediately. There's a second installment, which largely was to sort of continue funding for the PPP program, the assistance to small businesses throughout the United States. The Federal Reserve has been given the ability to have $2.3 trillion in additional lending support. The Fed also, we cut interest rates almost immediately to 0 to 0.25% with a commitment to maintain very low interest rates going forward. And we've created at the Fed a number of new lending facilities, a Main Street lending program for small and mid-sized businesses, and a municipal liquidity fund to be able to support state and local governments. So a lot of government action has gone forward. So what's Michigan received? So PPP has been one of the most probably noticeable programs, particularly for sort of bolstering smaller and mid-sized businesses. Michigan has had, in the first round, it had, 43,000 recipients with $10 billion worth of money being pushed into the economy. Second round, 60,000 recipients with $5.5 billion being pushed into the economy. So almost $16 billion in PPP funds have been put into Michigan. The region as a whole, sort of the Midwest, has received almost $88 billion worth of PPP funding. And clearly this is going to help soften some of the blow, but obviously it's only a short-term measure. So this The last couple of things I want to think about is again, sort of the fiscal estimate side of this. So there's, again, the business side, and then there's also the government side of this. So Moody's Analytics has created a number of ways to think about fiscal stress and sort of how exposed different states are. And what they did was first do an estimate that was the tax revenue shortfall that would occur, again, based on what sort of the funding structure is of the state. As you can see, what they expect for Michigan is a fairly elevated effect in terms of a general fund drop. So they're seeing an 18.6% drop in general fund revenues over this period of time. That's higher than most of the other adjacent states. They're also seeing a much higher spike in terms of Medicaid expansion within Michigan, with that adding more pressure to the government on the spending side. So a fairly large fiscal shock. I mean, again, a 27% fiscal shock is what they're estimating, and a combined value of almost $2.8 billion. So Michigan, again, is even though it had significant revenues going into this, again, it's the characteristics of the economy and the characteristics of both program utilization and the revenue structure that's going to make Michigan have a bit harder time than maybe some of the other states within the region. One of the things you have to ask yourself, though, and this is where Michigan did a pretty good job, is it did build up a cushion headed into the crisis. So this is two other estimates that Moody's did, which was to show basically what the revenue shortfall would be based on a baseline, sort of a moderate stress scenario, and then a severe stress scenario. As you can see, Michigan, even with, again, having a composition where it's perhaps more exposed from sort of a, baseline economy perspective, still is going to do better than, say, Illinois, which went into this with no reserves whatsoever, and really is totally exposed in terms of all the costs of COVID having to be paid up pretty immediately. So Michigan is going to be impacted, but again, they have a bit more of a cushion simply because they had more savings going to this period of time than, say, Illinois did, although clearly less than many of the other states within the Midwest. So the estimates that Michigan, the state, has produced on revenue decline are sharper than what these Moody's estimates were. The most recent ones have shown almost a $2 billion decline in general fund revenues for the current fiscal year, and a $1.25 billion decline in the school aid fund, and then similar levels of decline, slightly lower, for fiscal year 20 and 21, with some recovery expected. But again, sort of massive gaps in terms of revenues going forward, which is going to have to be some sort of strategy for how you're going to deal with that. The one thing I do want to leave you with some good news. So one thing that Michigan really has done extraordinarily well is institute policies that really sort of flatten the curve. So as you can see, Michigan has been one of the most exposed states in the country in terms of cases, COVID-related cases. But as you can see, by all these major counties within Michigan, once the peak was hit, which was basically 30 days out, the curve flattens for all of these counties. There's been obviously very significant voluntary and governmental policies that have been put in place to sort of really try to limit the impacts on the healthcare system and to sort of support Michigan going forward. So this is something that really is, most states, I think, if they had curves like these, would feel that they had, been reasonably effective in terms of trying to meet at least the healthcare crisis part of this environment. So the last thing I want to leave you through is just some sort of thoughts to ponder. And this is just some sort of other adjustments we're thinking about in terms of future economic activity. The first thing is I borrow from the consulting group McKinsey. One of the things they've emphasized is that maybe one of the things we'll have to think about in the future is building what they call the resilience economy, which is, for years, we've been trying to reward firms and, frankly, even governments for having kind of a just-in-time manufacturing mindset or production mindset, where the idea is to run really lean in terms of what your inventory is, to not have necessarily lots of extra stock on hand. There may be now a desire to sort of unwind some of that and actually build in more resilience into the economy going forward, build higher reserves, and be able to do that. That'd be a change in behavior from what we've seen in the past. Another thing that could be a fundamental change is we've gone through really 2 decades now where economic activity has been increasingly concentrated in cities. Urban areas have been one of the big winners coming out of the Great Recession. And what we've seen is a desire for density to be a real advantage in terms of economic growth. And the issue now is are we going to want to de-densify? Is there going to be a desire maybe not to have as dense an economy or to put so much emphasis on economic activity being based in dense urban places? Something to consider going forward. Another reality is going to be teleworking. Obviously, almost all of us have been working from home now. One of the things is that we find teleworking is actually more productive than we thought it was. Is it going to be an easier option for firms to say, we really don't need to have all of our workforce in the building on any given day of the week? That's going to have a significant impact on transit systems. Mass transit systems may never see the same ridership that they saw in the past, and that could be a big change going forward. A related issue is going to be commercial floor planning. This has been the year of open floor plans, with the idea where everybody is going to be in shared office space. If you think of the WeWork model, the whole idea was to really sort of stack people on top of each other in very dense locations. That may not be the model going forward. If social distancing is going to be desired, we may go back to more cubicles. You may need to have more square footage per employee. Again, you may not necessarily even want as many employees in the building any longer. So that can be a change going forward. And then the last thing I want you to think about is that you may have to bring on unintended costs that you never really planned for. Following 9/11, businesses had to increase security measures significantly. You saw things, such as metal detectors, screening devices, building sort of barriers around the perimeters of buildings, things like that. Those were unintended costs that businesses hadn't faced. Now you may have to be doing things like spending on health screening devices or things that also you hadn't necessarily planned on in the past. So that's also something to consider is will you have these sort of costs that are related specifically to dealing with health problems within your workplace that you might not have to build into future budgets. So with that, I thank you for your time and attention. I'm excited to hear your questions or your observations, and thanks again for giving me the opportunity to talk to you today.
Well, fantastic, Rick. Thanks for joining us today. This is Tim Maraz, VP of Strategic Initiatives for the Right Place. You definitely gave us something to think about moving forward. So in a time of uncertainty, thank you for laying out a lot of those ideas. As a reminder to everybody on the line today, we've got about 160 people joining us. If you have questions, please feel free to use the Q&A chat at the bottom of the screen. That Q&A chat will come up to me, and I'll be able to put things in the queue for us as we go forward. So I guess, Rick, just to get us started, I will start where you ended. Let's talk about the virus itself. There's been a lot of discussion from folks, on a national level of, how do we slow or stop this economic slide? How do we turn things around? And a lot of the conversations seem to be economic driven, where many economists are coming back and saying, you want to control the economy, control the virus. What's your take on that?
Yeah, I think it's absolutely true. And again, it probably goes back to my comment about consumer behavior, which is, early evidence is even the cities that have tried to places have tried to relax behavior, is consumers are just really nervous about going back out. And I know that's going to be the same thing for workers going back to the workforce. As much as they want to be back in their offices, they really want to make sure that there's a strategy for protecting their health before they return. And that's going to delay things until you're able to say that, yes, we have a strong health protocol that's going to protect you in your workplace, or that there's, a reasonable understanding that we know how to manage the virus going forward. So I think that's why a lot of people say that even if it's seen that we've sort of flattened the curve in terms of the exposure to the virus, that you're still going to have a very sort of halting recovery. They'll go in steps. So clearly I think, as almost many people have said, this is going to be dictated by the virus more than it is by our desires maybe to restart the economy.
Awesome, thank you. And we've already got a lot of questions coming in here regarding the slides in this presentation. I believe we are recording this, and we do have the slides as well, so those will be available on our website. So For those folks that are typing that question, just know that one. We're going to do is we're going to jump around a little bit, Rick, on you, if that's okay.
Sure.
We've got a question coming in here, a little bit more specific about metal stamping and tool and die. More on the manufacturing end. Where do you see that, going both in the short term and midterm as we recover?
Yeah, we did see as a group that metals were one of the more exposed manufacturers in terms of this, having sort of immediate effects. Clearly, I mean, a lot of it's going to depend on sort of what their customer demand looks like. And here I'm not going to even pretend I'm an expert. I think that for many cases, there's a concern that some metal related production, I mean, I know particularly those that was related to sort of oil production and things, have obviously shut down considerably over this period of time. And I think there's also going to be some concern as to, again, whether durable products are going to pick up. But this is, a lot of uncertainty. I mean, again, if you have, some certainty that things can recover normally, there actually could be some pent-up demand that could be released and could actually help these industries pretty significantly. If it's a more drawn-out period of time, I think it's going to be a much tougher story.
I was going to say, related to that, I know we've been hearing here in West Michigan some concerns from the manufacturing sector on they may be able to restart operations when the state opens up, but what will my supply chain look like? We have different states opening up at different times. Regarding supply chain, especially being an international supply chain for most folks now, is that something you guys are watching? Do you have any input on that?
Yeah, that's absolutely. It's a great observation. It's certainly something we've been seeing a lot of. For even manufacturers that were operating as essential throughout this period of time, so they've never shut down production. Many of them now are saying that they are seeing strains in their supply chain, particularly if they're internationally exposed. If your supply chain is out of China, if it's out of Asia, they're certainly seeing much larger problems than if it's domestic. But even in domestic, you saw this sort of contrast between, in many cases, the end producer was deemed an essential business, but their suppliers weren't an essential business. So they were shut down during the period of time in which the manufacturer was able to continue production. And now there's sort of a gap that's opening up. You even saw that this week, with Ford. I mean, Ford reopened and they said that they were already seeing some gaps in inventory that was making it hard for them to open up to full production. So it's something to watch very closely, and it's going to be a really important thing is how the supply chain fits with this period of recovery as we open up manufacturing broadly.
Good deal, thank you. We have a question coming in from one of our listeners today, asking you had mentioned about increasing savings on a personal level, folks that are starting to save in a crisis. However, there is concern that, even going into this crisis in a strong economy, we still had a large portion of our population, quote unquote, living paycheck to paycheck or struggling at the bottom of that income. How does that fit into that overall economic story as we go into a crisis like this? We've seen the PPP come out, but, what about folks on an individual level?
Yeah, and again, a great question. If you look at sort of the broadest demographics of this, there is no doubt that actually people who had the least going into this have been the most exposed in terms of having direct effects from the virus. Low-income communities in particular have had both higher caseloads, and in many cases, they work in the very industries that have had the biggest layoffs. I mean, they work in service industries that have been essentially shut down over this period of time. So the exposure is even more extreme for them. So there is a concern as sort of the distributional effects, and particularly this is hitting low income and poorer communities more than it is, broadly the rest of the economy. There's a sense of that. Now, clearly that was part of the reason for doing the expanded unemployment insurance benefit, the $600 add-on. But that in and of itself is also going to expire at some point in time, and it only is, again, be sort of a stopgap measure.
Got it. Very important question coming in here. Another one from the audience regarding commercial real estate. We can imagine what's going to happen, especially on the smaller retail space side, much less the larger commercial industrial. Is that something you guys are tracking? What does it look like near term and midterm?
Yeah, so commercial real estate, I mean, the good news for them is that the first month of exposure wasn't bad. I mean, if you talk to them from their commercial tenant side, they were seeing roughly anywhere from 85 to 95%, depending on the metro, of their tenants paying rent. So they weren't exposed there. On the retail side, it's a completely different story. Retail, rents pretty well cratered almost immediately and have continued to fall. You're seeing most retail tenants now asking either for forgiveness or for some sort of a adjustment in rent payments for the next year or 2 years. So retail is going to be really exposed. The other concern is going to be about vacancy rates. Retail, if you're talking about, potential for a lot of restaurants not to be able to come back from this, you're going to have a lot of open retail on the sort of the ground floor level. And again, on a commercial basis, a real story is going to be whether or not everybody's going to want to have the same occupancy in their buildings. So if you have a higher percentage of your staff every day telecommuting, and maybe you don't need as much floor space as you have in the past, so that could also spike vacancies in terms of that. An interesting thing I heard is they also could change the distribution of where commercial activity is going to want to take place. There's some who are suggesting that you'll build in sort of redundancy centers, maybe in suburbs or smaller cities, to sort of move some of this activity away from large, dense urban areas. So there's anecdotal evidence that's already happening in New York City, where suddenly upstate New York and Connecticut looks like an attractive place to have sort of secondary facilities for some particularly large banks at this point. So it's going to bear watching at this point. It's mostly anecdotal at this point, but the idea will be see if this becomes somewhat of a structural change.
Yeah, thank you for that. I have a couple of questions here that all kind of along the same line, the theme of the various government stimuluses that have come out. You mentioned, the 80, I think it was 88 billion, maybe it's more than that. The unemployment stimulus that came out. There's concern that there's a lot of government spending going out there, obviously raising debt levels, and what impact may that have on the devaluation of the dollar or increasing inflation rates here in the U.S.?
Yeah, it's a great question, and it's clearly a concern. Again, when you're looking at right now, the positive side is the federal government obviously is able to right now borrow and fund some of this additional debt at extraordinarily low interest rate costs. So from a purely interest rate perspective, if you were going to have to take on record levels of debt, now would be as good a time as any to take it on. However, that being said, you still are going to have, extraordinarily high deficit levels for the U.S. economy. And again, just unprecedented levels of debt that are going to have to be managed going forward. And in the past, there's always been a concern that this will be inflationary and also would hurt potentially the value of the dollar as a sort of global currency. On the interest rate side, on the inflation side, what I'll say is that there was some expectation that this was going to happen coming out of the Great Recession. We didn't see that because we didn't see necessarily inflationary channels really picking up that much. We didn't see inflation in commodity prices. We didn't really see that much inflation in terms of labor costs. And part of that was an argument that maybe globalization has sort of tamped down some of the inflationary pressures that historically were associated with this kind of buildup of debt. We have to pay close attention to that. Managing inflation coming out of this is something we're going to worry about. And again, in terms of the debt levels, the U.S. economy still has one of the stronger economies right now in the world. So there hasn't been a desire not to buy U.S. debt at this point. But that's something hopefully we're going to be able to sustain and still be the sort of the best economy that people are going to want to invest in regardless of what debt we're carrying. But it's great questions, and there's certainly something that, there's no certain answers at this point about.
Deal, thank you. So the next one, I'm impressed. This is a fairly economic-based question, so I'm going to read it the best I can. But the question is around GDP forecasts, and are they factoring in employment and productivity that considers the PPP supplements that have been put in place? But once that funding influx discontinues, are we going to see yet another hit or a wave in terms of unemployment as that works its way through the system?
Yeah, so the figures that I showed you, I mean, most of the forecasts do actually include the PPP and any of the sort of immediate government stimulus. And so the very large declines in the second quarter really reflect just how high the unemployment levels are and how that can't be compensated for through any level of government spending, really, even in the short run. In the longer run, I think that's going to depend on, again, what your scenario is for recovery. If we're able to, again, sort of get people back into the workforce and sort of open up economies and get demand back, then I think you won't see sort of second wave unemployment numbers. If demand, though, falls away, and when we get this sort of second wave effect like we've seen now in manufacturing, and there simply isn't customer demand, then you could have industries that previously had seemed fairly resistant to sort of the immediate downturn all of a sudden become more exposed going forward. So it really is going to depend on sort of what your scenario is for what recovery looks like and what demand is going to look like. And, that's also an international study, because you're going to have to look at sort of like what are other world economies doing? What demand are they going to have for US products, and how quickly will that come back?
Yeah, thank you. Another question we have, talking specifically about the stock market, and we all know you have to separate the economy from the stock market, but the question bears, is there sort of a rationale to, for the strong stock market recovery that we're seeing?
Well, as I said, I mean, I'm obviously not a stock market analyst, but I think you're right. I mean, I think that again, the rationales I've heard is a expectation or a hope that this is more of a situation of a cash flow problem, where again, much of this demand actually comes back once we have more certainty that the health dimensions of this have been addressed, and a significant hope, I think, that this will be addressed in a fairly reasonable period of time, so that you're looking at pretty robust recovery at least into 2021. And then the other thing again is sort of the conditions for businesses to be able to sort of borrow or to fund themselves going forward in a essentially zero interest rate environment. That's going to be fairly favorable. So access to capital should be pretty good for businesses, and maybe this will help them with their recovery. Clearly short-term earnings are going to be crushed over this period of time, but the hope is again that you can sort of get a reasonable level of recovery and a fairly sharp level of recovery once things are more certain.
Yeah, thank you. So I'm going to switch gears for a second. I'm going to ask one of our questions while we continue to get more questions in. Again, folks, if you have questions, put them in the Q&A. We'll get to as many of them as we can before the end here. But Rick, one of the things you had talked about is, and it's not getting a whole lot of conversation right now, is that municipal side of finances. We have, on the call today, several municipalities and local townships and cities and counties participating today. You mentioned some of the potential risks at the metro and state levels. What advice, I guess, policy-wise, would you give to a lot of these regional and local municipalities as they're staring down the barrel of the rest of 2020 looking into 2021?
Yeah, I wish I had some optimistic advice to give them. I mean, I think one thing you have to realize is that, for the most part, I mean, states and local governments really, one of the lessons they learned from the Great Recession is they actually had built up fairly significant reserves. In fact, the reserve levels in aggregate were sort of at a record high going into this. So they clearly had behaved to try to cushion themselves from sort of a normal recession, if you could call any recession a normal recession. However, they couldn't have possibly built up enough reserves to be able to weather this kind of a storm. And I think that the concern is that part of this is this sort of flows through various levels of government, is that particularly local governments are worried that state governments are going to cut aid. Again, revenue sources are going to dry up in the short run. They may be forced into short-term borrowing that may or may not be, advantageous for them to take advantage of. So a lot of coping mechanisms, and I think that, the greatest concern that most people have is you're going to see cuts to essential services coming out of this, that, you'll see, furloughs, layoffs, in services that people really demand and really, want to support, just as a coping mechanism. Because again, I mean, if you're a state or a local government, one of the things is you can't deficit spend. You have usually, actually balanced budget requirements, and so you're definitely more exposed in this kind of a cycle.
So several of the questions we've been getting coming to the feed here are talking on the small business side, and I'm going to split this question in two. So the first part of this is specifically, those businesses that are involved in entertainment and service-based businesses, things like arenas, concert venues, those types of places that, at least in the state of Michigan, it's going to be a while before we see that open up in any sort of a mass scale. What sort of pathway to recovery do you see for that entertainment and service-based industry?
Yeah, and again, I mean, you hate to just try to be, speculative. I mean, again, I think it's almost then it's a health question, right? Which is, if you can ensure people that being in a mass crowd is going to be a safe thing for them, then you can bring back those activities quite quickly. If you're in a situation that even if you can say, like, there's not many cases breaking out, you can maybe sort of go back there. I mean, I think that the biggest challenge for most of these businesses is they simply aren't designed to be able to operate at 25 or 50% capacity. So if you maintain sort of social distancing, measures or things like that, you're still going to have a situation with, like, well, you're going to have a concert, but everybody has to be 6 feet away from each other. That maybe puts 25% of people into a venue. It's very hard to make that actually profitable or even sustainable going forward. So you really have to come up with a model where you can fully open these operations up. I've heard the same thing from many restaurants, which are saying, it's helpful to be able to say you can operate at 25 or 50% capacity, but that doesn't really change their cost. They can't change their cost structure enough to make that actually workable for them, over any sort of, longer run period of time.
Gotcha. Well, and I guess I will end on this one, and then we'll kick it back to Birgit. Is one of the things we have talked about is the importance of primary or base employers, depending on the term that people use, for a community in a regional economy. We've seen a lot of stimulus money come out for traditional Main Street small business, 50 employees or less, 25 employees or less. But for that middle market, those what we call base employers here, from an economic standpoint, can you talk about sort of the importance of both, or and particularly base employers, because I don't think that there's a lot of people talking about that right now.
Yeah, I think it's a great observation. I mean, again, these base employers are the ones who actually employ a large percentage of the U.S. workforce. So, many of us don't work necessarily for, large, huge corporations that are sort of being featured in this. So, the effect, and on top of that, they're also the local employers within communities. So the impact they have on the communities, I mean, if they're not being successful, they're not able to hire people, they're not able to retain their workforce, they're less able to pay their taxes. I mean, there's a significant kind of domino effect, when those are the, parts of the economy that are being exposed. And again, how you reach them effectively, again, a lot of the programs that have been put in place are, sort of broad brushed. I mean, they're blunt in terms of their behavior, and they may not be as targeted to what individual communities would like in terms of being able to identify those sort of key employers that they see that aren't, sort of, headline, household names, but are incredibly important to their local economies. So yeah, I'd like to see more being done to sort of, think about how you support those industries going forward. It's certainly something that probably requires some more policy.
Fantastic. Well, again, thank you for your time today. This is kind of a rapid fire Q&A session. With that, I think we'll throw it back to Birgit, let her close us up for the webinar session.
Thank you very much, Rick, and thank everybody on this call, on this webinar. It's very much appreciated, and I hope that the information that was shared with you today is helpful as you all are starting your business again. Again, the presentation will be shared with all of you, and it will also be posted on our website. And we will be hosting another Navigate 2020 webinar in June, and it will be about the automobile industry and the supply chain. And we will share the details with you as soon as we can. So that concludes our webinar for today. And I have to tell you, I would love to see all of you in person, and I hope it won't be too long before we can do this. Thank you very much for participating today.